So this is what they were testing. You are given this information. Mr. Alex Mawezi, an audit client, has been trading for several years. He has provided with you the following list of account balances as at 31st of December 2022. So we have capital, we have revenue, trade payables, returns outwards, expected credit loss as at 1st of January 2022. That is the balance brought down. Then we have discount allowed, discount received, purchases, returns inwards, distribution costs, drawings, rent, rates and insurance, heating and lighting, postage, stationery and telephone, advertising, salaries and wages, credit loss, that is bad debts, cash in hand, cash at bank, inventory at the beginning of the period, trade receivables, PPE, that is property, plant and equipment. So it means you've opened a different paper. If you open the sitting for April, question number 25 is what we are tackling here. There are two different papers there, so just look for the right one. Then after this, after depreciation expense for the year, we have this. As you begin the audit process, you discover the following adjustments that should be made to finalize the financial statement as you carry out the substantive tests. So these ones here are basically the adjustment that you need to make that we have there. Then you are required to do the original trial balance without adjustments, the adjustments to be done. Then we have draft profit or loss items. The draft statement of financial position is what is required there. So it is basically taking you back to financial accounting at foundation level. You are given information there. You need to know whether it is a balance sheet or a profit or loss item, whether it is an asset or a liability or a capital. Once you've been able to identify that, are you able to do the necessary transactions or adjustments whereby an increase in capital account should be credited while decrease should be debited? Then revenue is an income statement item. We credit that. Trade payables is a balance sheet item which should be credited. That's a liability. Returns outwards is forming part of the cost, but then it is reducing the cost of purchases or cost of sales. You made some purchases, but there was wrong packaging or they gave you the wrong item in terms of quality or quantity. So to take care of that, you've returned these goods back to the supply. It means it reduces the purchases value. So how do we treat that? Discount allowed, that is the discount you receive. That's the discount you give to your customers when they purchase goods. So how do we treat that? Is it going to increase? Is it going to increase your sales or it is going to reduce your sales value? For us to arrive at net sales, when we've allowed or we've given out discounts, then we have to do away with the discounts to get the real sales value. Discount received, when you're going to do purchases of the raw materials or the goods that you want to resell, you've been given discount. The original price is maybe 10 million, but you've been given 5% discount. So it means you are not going to pay the 10 million. You'll be paying 95% of 10 million. So it means discount received reduces your purchases value. We have purchases itself here. Then we have returns inwards. Your customers have been able to buy goods from you, but in the process, you did wrong packaging. You gave them wrong item in terms of brand. So they have to return it back. So when they bring it back, it also reduces the value or the total amount of sales. Then we have distribution costs. Of course, that's now falling under operating expenses. being part of the income statement item. I have drawings there. Rent, rates, and insurance, that's an expense. And you may even find that in the process, you're going to have prepayments or accrued expenses. How is prepayment affecting our expense account? How is accrued expense affecting our expenses account in the current accounting period? That's what we need to have in mind. How do we treat bad debts? Do we have any provision? Cash in hand, cash at bank, those are assets. And they are basically, specifically current assets. Inventory as the beginning of the year. We have trade receivables, that's an asset, that's current asset. Property, plant, and equipment, we have to consider, is it at cost? Yes, we've been given that it is at cost. So we have to bring in the depreciation or the accumulated depreciation up to the end of the year for us to be able to get the net book value. So how do we get the net book value? It will be the cost plus accumulated depreciation. So this accumulated depreciation as at 31st of December 2022, this was the value. And then we have depreciation expense for the year. So if you are given this accumulated depreciation as at 31st of December 2022, the information given to us here also is as at 31st of December 2022. So it means this depreciation expense is already included in this accumulated depreciation. And therefore, our net book value of PPE will be cost minus accumulated depreciation. But then you have to also look at the additional information to see if there is any item that will be affecting our accumulated depreciation or will be affecting our depreciation expense for that particular year. For example, we are able to see under additional information number 4, where we have the errors or omissions, that depreciation expense for the year is understated by 120,000. It means what is here, what is provided here is less by 120, is less by 120,000. So what are we going to do? We have this 120,000 added to the depreciation expense, which will be taken to the statement or profit and loss statement. Then that same 120 will be added to the accumulated depreciation because it was omitted. It was omitted, not included. So it's going to increase the value of accumulated depreciation and at the same time increase the value of depreciation expense for that particular year. Then if you look at these other expenses, we have closing inventory. Of course, we know how to use it. For us to get cost of sales, it will be opening stock, that's opening inventory provided up here. That's opening inventory provided up here. Then we have this, let me just show you that. So if you want to get cost of sales, for us to get cost of sales, we are going to have our opening stock. Then we add purchases. We add purchases. Then, do we have anything in the name of carriage inward? Do we have anything in the name of carriage inward? The amount that was incurred to transport these goods to the company's premises. Do we have it here? No, it is not there in the information provided. So basically, we just need to get the net purchases, which is less returns outwards. Do we have returns outwards? Return outwards. Return outwards. We have it there. Then at the same time, we also have discount. We have discount received. When you purchase these goods, you are given some discount. When you purchase these goods, you are given some discount. So we have to indicate it there. After that, do we have anything that will be affecting cost of sales here? We only have closing inventory. So at that particular point, we are going to get what we call cost of goods available for sale. Available cost of goods available for sale. So once that is taken care of, let's see, our opening stock, that is inventory at the beginning of the year, was provided here as this. That's our inventory at the beginning of the year. We need to add purchases value, which is given here. Then we also have returns outward. So we are going to subtract the returns outwards, which is provided up here. Then discount received will reduce the discount received is also given up here. Discount received 875 for us to be able to get cost of goods available for sale. So this is what we have. The discount allowed is what you give to your customers. It reduces the amount you are going to claim from your customers in the name of sales. So this discount received, is it an income or expense? 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 Yes, it is. It is an income. And remember, if it is an income, we are not going to recognize it here under the classification of the cost of sales. It will be after we have our gross profit, then we have the section of other income. So that's why we are going to place it. But then the discount allowed will not form part of the sales. No, it will now be treated as an expense. So what we need to know is that discount received and discount allowed, yes, they are going to affect our sales and purchases, but not directly as we may see it. We either classify it under income or expense. And for that matter, discount received, which we have here, will not form part of the cost. It will be taken as other income after we've been able to calculate the gross profit. So the cost of goods available for sale will be opening stock, add purchases, less returns outwards. So that is what we have. That is what we have there. Why returns outward is forming part of the cost of goods? Returns outward is I purchased goods worth 73,755 million. But then out of this, I returned back these goods to the owner of what value? 67,003,500. So what is the real purchases value? What is our real purchases value? I purchased goods worth this, but then I did not sell everything. I returned back this value of goods to the supplier. So what am I having as the net sales, net purchases? What's our net purchases value? It is the total or the gross amount of what I purchased minus what I returned back. And that's why returned outwards is forming part of the cost of sales. And there's something that is not given here, but maybe in the next sitting or in the next question, they will bring it. We call it carriage. We call it carriage inwards. Carriage inwards is the transportation cost that you incur to take these goods to the company premises. That is where it is. So the carriage inward is used to bring in the items purchased into the company. And that's why we take it at that particular point. Since it was not provided in this particular question, there is no need of indicating it there. So we just omit, but as you do your studies, know very well that if a question is given to you and you have carriage inward, it will be inserted in this particular place. Now that we have the cost of goods available for sale, we did not sell everything. We did not sell everything. There were some goods that remained in our store. So the goods that remain in the store is what now we say less closing stock or closing inventory. So closing stock is what you get at the end of the year. If you're given closing inventory as at 31st of December 2022, then that's what we take as the closing inventory. So this one here as at 1st of January, which you can also see, they are not telling you whether it is closing or opening. They know very well that by giving you the date, they know very well you'll be able to identify what is opening and what is closing. If it was there, we will add it. But because this question was not having that, it is not going to add any marks to you. It will not add any value to your workings. So let's come at this point here and look at the closing inventory, which we have been given as 87. So that closing inventory, remember we subtract it for us to be able to get now the net cost or the real cost of goods that were sold. The real cost of goods that were sold. So I can just indicate a negative there to have that, and then I am now able to have my cost of sales. I'm now able to have my cost of sales. That is the cost of sales. But I believe maybe there are some adjustments that I've not even looked at. Maybe the purchases was understated or overstated. The carriage inward, they used a wrong value, which we now need to look at. So let's see errors and omissions. Errors and omissions. Errors and omissions. As you can see, an invoice for goods sold was not posted. So sales value, whatever is given there, is not real because there are some goods that were sold, but it was not included to be part of the revenue here. So your revenue value here, you will add the omitted invoice amount so that it gives you the real value of what was actually sold. Then there we have something here. Let's see. We have something here. That is how we get the cost of sales. I just want us to pick on some things to help us understand what we are actually doing. I want us to get the net book value of PPE. That is property equipment. So let's call it PPE to make our work simple, because having done FR, you understand these assets when we use the term PPE. Will you take returns outward as part of costs of goods? Okay, if these people were in the manufacturing sector or they were doing manufacturing, then it means whatever they are purchasing, of course, they can purchase the finished product but still manufacture, or they can just be purchasing raw materials and manufacturing the finished product which they sell. So what happens is this: in that case, they will indicate to you that return outwards. They indicate to you that return outwards is for what they purchase. And what are they purchasing in that case? They will indicate whether it is raw materials or they also purchase some finished goods. Because if they are doing manufacturing, in the place of purchases, if they are not doing any, we are going to have what we call production cost. We are going to have what we call production cost. All the amounts incurred to convert the raw materials to finished product. The finished product will be transferred to the selling department or to the other department of the company that now, or to the store department, either at a markup or at a margin. After incurring the cost and they find that they spent a total of 5 million, they can decide to bring in a markup of 5% to transfer these goods now to the other department. That department, which is receiving the finished goods, will be recording the production cost plus the markup, or the cost of producing these goods plus the markup cost, to give us the product cost, which replaces now the purchases section. So we are going to have, if you have the manufacturing department, of course, you are going to have opening stock. So this is what you could have done. We have opening stock of raw material. Opening stock of raw material. Opening stock of raw material. Then you add purchases of raw material. Purchases of raw material. Then we less return outwards of raw material, carriage inwards of raw material. Then we get costs of raw materials available for use. Remember, raw materials, they are not selling, they are using them. So instead of cost of goods available for sale, we have it as cost of raw materials available for use. Then we less the closing stock of raw material, which was not used, for us to get the cost of raw materials used. Once you get the cost of raw materials used, we'll now come up here and add the indirect expenses. They are spent or they are incurred in the manufacturing department, but they are not directly related to the material. So that's where we are going to have the labor, the direct labor. That is manufacturing or a management accounting term. We can call it now, we have salaries and wages for production manager, or salaries and wages for the production department. Depreciation of plant and machinery. Light or heat and lighting of the factory. Will be, all those costs will be added. We are not going to subtract them. They will be added because they form part of the cost of this particular product. At the end of it down here, we are going to have what we call, so let's say we have product cost. So if you add everything, let's say you added everything and this is what you got. After adding everything, you are going to get this. So this is the product cost. And then the company says, we cannot be doing everything as a manufacturing department and give it to the sales department at zero profit. No, we have to add something on it. So what are they going to do? They are going to add profit margin. So when they add profit margin, let's say they can say we want to add it of 15%. So we come here and say their profit margin is equivalent to 15%, is equivalent to 15% of this. That is it. So it means production cost. Production cost is equivalent to the summation of these two. That is product cost plus the margin that has been added. So this is what we have as the product cost. So if you now move to, let me just give you this here. Let me just bring it here. So if you add this, so we have opening stock, of course, now not raw material, purchases of finished goods, but that one you're going to replace. Then we have return outwards, or if it is not there, you indicate zero. Of course, they are going to classify, is it return outwards of raw material or of finished goods? So we are going to have opening stock of finished goods if it's a manufacturing company. This one here is for manufacturing accounts. Then you now come to profit or loss accounts. Profit or loss accounts. where we are going to do this. So we have opening stock of finished goods, then we add purchases. If they are also purchasing the same product they are producing from outside, but if they are only using what they are producing internally, we are going to say add production cost, add production cost, which we now lift it from this particular point directly. Then we bring in the returns outwards if it is there. If it is not there, no need even of inserting it there. Carriage inward, if you are incurring any, of course, the carriage inward will be for raw materials. So we don't need to have it here unless they have stated that it is there. You get costs of goods available for sale, then you less closing stock of finished goods. You less closing stock of finished goods for you to be able to get the cost of sales, the cost of sales, or the cost of goods that was sold. Is it now clear to someone? Matthias, is it now making sense to somebody? Is it now making sense to somebody? Okay, that's nice. So let's get back to this. Let's now get back to this one here. I believe that's what we had. Okay, so after getting cost of sales there, I want us to look at PPE here. That is the asset. So for the asset section, the non-current assets, they will be giving you the depreciation rate. They will be giving you the depreciation rate, whether straight line basis or reducing balance method. So for our case here, the examiner was lenient enough and gave us the depreciation amount. We don't need to look at the rate. No, all that was provided. So I want us to understand, if you look at what you are doing, the T account is going to help us understand or get sense out of this. The T account will help us get sense out of this. So here we want to have accumulated depreciation. Accumulated depreciation account. Accumulated depreciation account. We are going to have it there. And then, so just have a simple question for us here. Let's say we can have that, we can have this, and then also this one here. So this one here will be our PPE account. This one will be our PPE account. Then this one here will be our depreciation account. Let's call it depreciation. Depreciation account, that's what we have. Then we have the accumulated depreciation. So my question to you is, for the asset account, do we normally have debit or credit balance? When we increase the asset account, are we going to debit that account or credit? So when we increase the asset account, we are going to debit. We are going to debit. So if you look at this here, we will always keep our account at cost if the depreciation rate given is straight line basis. If the depreciation rate given is straight line basis, then we are going to keep our asset account at cost. The only thing that should be affecting our asset account is the disposal of our asset, which we'll be looking, or we are going to deal with the disposal when you're going to do the cash flow statement. That's where they now bring in the concept of disposal. But at this point, of course, it can be given, but for our question, it was not given. So it means there's no other asset which you also told that was purchased during the year. So what we are going to do, we are going to keep our asset account at cost, which we are able to see that balance brought down because none was purchased. So our balance brought down for this particular asset is equivalent to this amount here. That is the balance. That is the balance brought down. Was there any asset that is non-current asset, that is PPE, which was disposed during the year? Are we having any information of that kind? That this particular asset was disposed of during the year? There is no disposal indicated there. We don't even have anything to do with proceeds on disposal of PPE. So it means at the end of the year, the asset, because we are keeping this asset account at cost, our balance carried down will remain. Our balance carried down will remain this particular figure, so that at the end of the year, this account will be balancing. At the end of the year, our PPE account will be balancing. Our PPE account will be balancing by what figure? By this. So that's the figure which we are going to apply. It should be the summation of everything here. So we can indicate alt equal to add everything there. Then we do that to this other side. So that's what we have. Our PPE account is maintained at cost. So nothing is going to affect that account. When we come to the depreciation is an expense. So increase in expense account. If we have increase in expense account, what do we normally do? If we have an increase in expense account, what do we normally do? Increase in expense account, somebody, increase in expense account. Phil, you are letting me down. Increase in expense account. Expenses have debit balances. Expenses have debit balances. And that knowledge is very important to us. Why am I saying so? The first question that was given to you is to come up with a trial balance. If you let me down at the initial stage of preparing a trial balance, which was covered in FA, then it will be a disaster, because all expenses are going to have debit, are going to be debited if there's an increase in the expense account. Now, this depreciation expense is the rate multiplied, by, it is the rate multiplied by the value given. So this account, the accumulated depreciation is an expense. It will be taken to profit and loss account. It will be taken to profit and loss account. Then for you to understand this better, we need to look at accumulated depreciation. Accumulated depreciation has got a credit balance, and this having a credit balance will be reducing the net book value of our assets. So we first of all come here and say balance. We say balance brought down. Balance brought down. And I want you to give me, because we can calculate that figure, what will be our balance brought down? What will be our balance brought down? Our balance brought down. Our balance brought down. How do we get balance brought down? Our balance brought down. Our balance brought down. What is our balance brought down? So if you look at this, we have accumulated depreciation as at 31st of December 2022. So this figure here entails the depreciation expense of the current year plus the depreciation expenses of previous years. So are we able to get the real depreciation expense of the current year? When we get that and deduct it from this, we will be able to get the accumulated depreciation at the beginning of the year. 31,500. That is what Madhya is telling us. So we are yet to get it. Let's see. Remember, this accumulated depreciation is at the beginning of the year plus the depreciation expense of the current year. This depreciation expense of the current year is already included here. But the only thing that is missing, our real accumulated depreciation is equivalent to this one here plus what was omitted. The depreciation expense is not just this figure only. There's that portion that is still missing. And where is it? Depreciation expense for the year is understated by 120. So it means this depreciation expense for the year also, which we have here, is understated. It is understated by 120,000. So the real depreciation expense of the current year, 61,57,000. That is the real depreciation expense of the current year. And now that the whole of it has been included to give us accumulated depreciation as at the end of the year, that is 31st of December 2022, the difference between these two will give us the accumulated depreciation at the beginning of the year. The difference between the two will give us accumulated depreciation as at the beginning of the year. That's the balance brought down. But now we are able to see that our accumulated depreciation at the beginning of the year is less than what we have at the end of the year. So what has happened? What has happened to the increase? Because at this point, at the beginning, we have 25,473. At the end of the year, we have 31,630. So it means that increase is caused by the depreciation expense of the current year, which we've been able to see as 61,57. So for us to increase our accumulated depreciation expense account, accumulated depreciation account value, we are going to do what? To bring in this figure, that is depreciation. That is depreciation. It is coming from depreciation expense. It is coming from depreciation expense account. It is coming from depreciation expense account. Of what value? The depreciation expense of the current year is equivalent to this figure here. That is what we have. So because the only thing that can affect accumulated depreciation is disposal of an asset that can reduce the accumulated depreciation account's value, or we have changed the depreciation rate and we are working it backwards, then automatically it will affect our accumulated depreciation account, or there is backward revaluation. The depreciation overcharge, if there was depreciation overcharge, then it means we are going to reduce our account. But if it is depreciation undercharge, it will increase our depreciation account, of which that undercharge, the depreciation undercharge, we've treated it here, we've worked it out directly. It was undercharged by what value? It was undercharged by 120,000. So we've taken that undercharge, added it up here, which we are able to see, and also added it to our accumulated, because accumulated was also understated. Was also understated by that same figure. Now, we've all seen that if we bring in the depreciation expense for the current year, we are able to come up with balance carried down. Our balance carried down is now what will give us the figure to balance this account. So let's get the summation of everything here. can even put it somewhere here. We can even put it somewhere here. So because there is no disposal, this total here becomes the balance carried down. This total becomes the balance carried down. Then you now get the summation of this. Then you now get the summation of this. So that is our accumulated depreciation account. Now, where did we get this? We got it from depreciation expense account. Accounting rule, we debit one account, we credit the other account. We debit one account, we credit the other account. So at this particular point, we are crediting the accumulated depreciation account, which means we debited our depreciation expense account. So where did this expense go to? We took it to the accumulated depreciation account. That is where it was taken to. And what is the figure? This is what was taken to the accumulated depreciation account. Depreciation account is an expense account. So how do we clear it? We should not have it there. So for us to balance this account, whatever is going to balance this account is being transferred to income statement account. It's being taken to income statement account. It's being taken to income statement account. Income statement account, which some people call P&L. P&L account. So that's why it is going to P&L account. So when you take the same figure to P&L account, if you take the same figure to P&L account, you will find that this account will be balancing. This account will just be balancing as such. So that is what we were supposed to do. If you have that knowledge, even before you move, if you have that knowledge and you've been able to do this, before even you move to your asset account or to the balance sheet, before you move to the balance sheet, you are now able to identify some key items here. Let me just create a space here. Then you see the sense out of it. So it means, let me have this format pasted here. So if you have that, I'll simply come to this particular point. Let me do it to this one as well. Okay, so once that is done, I think I can now have sufficient space to do all this. So I can simply come here and say debit and then credit. So I've now known very well, just by dealing with these two items, the PPE. So I know very well that asset account, what do I have as the balance brought down? It has a debit balance. So I will come here to my PPE, property and equipment. I know very well it has got a debit balance. That's where I'm going to put it. Then, if I come down here to depreciation is being transferred to the accumulated depreciation account and also P&L. When I come to accumulated depreciation, I have clearly seen that it is going to have a credit balance. It is going to have a credit balance. And this credit balance is of 31,630. So I just come up here, look for my accumulated depreciation. I know very well it's going to have a credit balance. So that's where I take it to. That's where I take it to. Then the depreciation expense for the year, depreciation expense for the year, I've seen very well that I'm going to take it to where? To P&L. I'm going to take it to P&L. That's where instead of having balance carried down on the credit side, I'm transferring it to P&L. And that's why if you check at your P&L, you'll always find it on the expense side. It is going to be debited in the P&L. So that's what you do. That's simple thing. That's what you need to do to deal with the trial balance, to do the adjustment. When you look at the prepayments, so by just doing that, I believe we now know that we can get the net book value if you're going to prepare the balance sheet. Our net book value of PPE, net book value of PPE will basically be equivalent to cost at the end of the year, which is this balance carried down. Then I subtract accumulated depreciation at the end of the year, which happens to be our balance carried down of accumulated depreciation account. So my net book value of this asset, when I'm going to prepare statement of financial position, is 28,740,000. Are we together? Are we together? Are we making sense to someone? Are these informations making sense to someone? Yes, that one, I have it in mind. Don't worry about that. Don't worry about that. So that is what we need to have in place. But then, just to make you understand something still, because those are some of the things which will be giving you challenge, but I need to address them right away. I have an expense by the name. Let me see the one that was given there. Insurance expense. So we have insurance expense and also rates. So if you look at this, I have rent, rates, and insurance expense. It has been combined to be a single figure. So I'm going to have rent, rates, and insurance costs. Let me just have it up here. Rent, rates, and insurance. That expense for this particular year is equivalent to 12,986,500. So what happened out of this expense which has been charged? Remember, that is the expense which has been charged to the income statement for the current year. But then out of this expense, is there some amount that was paid in advance so that it reduced our expense for the current year? Or is there some pending amounts that was not paid in the previous year so that we add it to get the total amount to be paid in this particular year? So it tells us that if we have prepayment, let's see, do we have prepayment or accrual? We have insurance that was prepaid, rates that was prepaid. So we have prepayment. We have prepayment. So the rent, rates, and insurance is this. There's this amount that was paid in advance. So the amount which was paid in advance, we have, because our rent and insurance has been combined together, and the two here are also separated. We just need to get the total amount. So we have that is the insurance prepaid and also prepaid rates. So it gives us the total prepayments. This amount was paid in advance. How is it going to affect our profit or loss account? How is it going to affect our statement of comprehensive income? It reduces what we are supposed to pay. It reduces what we are supposed to pay in the current year. It reduces what you're supposed to pay in the current year. So I subtract. It means all prepayments are subtracted from the expense so that we get the real expense. We get the net expense, which we are now going to take to our statement of comprehensive income. So this is what we are going to take to our statement of comprehensive income as the net expense of rent, rates, and insurance. That is when we deal with the prepayments. We subtract. Prepayments are deducted. How about accruals? Do we have anything that is related or we have that is accrued? So we have eating and lighting. Eating and lighting as an expense on its own, we have it here. So let me just extract that. Let me just extract that here. Eating and lighting and get this figure. Eating and lighting, that's what I have. Maybe there's a question. So what are we looking for? Okay, Ododa, what we are doing here is we want to know if you are given prepayments in a question, what are we going to do? The rent and rates figure, which we are going to take to the statement of comprehensive income, is not what you are seeing here. It's not 12,986,500. No. Out of this 12,986,500, there are some amounts that was paid for in advance. We have to eliminate them for us to get the real expense. So we are trying to look for the items that we are going to use in our statement of comprehensive income under expenses. One of them is rent, rates, and insurance, which we are now getting what we are supposed to take to that account. So that's how we treat the prepayment. When we come to eating and lighting, for the current year, the amount that's supposed to be an expense is 5505. Is 5505. But then there is some amount, some expenses which was not paid for in the previous period. They were accrued. So if they were accrued, they are being adjusted. Accruals, or accrued expense. Do we have any that was not paid for in the previous period? Under eating and lighting, do we have any that was accrued? So additional information is telling us that eating and lighting accrued is equivalent to 680,000. So the expense that has been charged for the current year plus what was not paid will give us the net expense. So that expense, when you're going to record now the eating and lighting in our statement of comprehensive income under expenses, we are going to indicate the summation of these two. We are going to indicate the summation of these two for us to get net expenses. So someone who is following me, someone who is following what we are doing here is able to see that whenever we have prepayments, we subtract it from the expenses that is related to it. Whenever we have accruals, we add it to the expenses related to it. It does not mean that when we have, let's say whatever we have here is accrued rates. So we come and bring accrued rates because we are told accrued expenses are being added. So we bring accrued rates under eating and lighting. No, you have to add it or subtract it with respect to the related costs. For example, if we add, we have rent, rates, and insurance. This is the figure. Then under prepayment, we only have insurance prepaid. And then for the rates, it is not prepaid, but it is accrued. So if this one is prepaid while this other one is accrued, we get the net effect. That is, we take what's supposed to be subtracted, we subtract, which is the prepayment. But the accrual, we now do what? We add it. If we're having accrued something here, which is under this category, let's say we have accrued rate. Accrued rate, remember accrual is being added. We could have added it. We could have added it here. We could have added it here for us to get that. So prepayment, we subtract. You can be able to say I have a negative here. Accrual, we add. So we could have added it. But because you are not having it there. You are not having it there. We're not having it there. What have we done? We just take this, the summation of the prepayments, we subtract, and accruals, we do what? We add. So this one here is what we take to our statement of comprehensive income under eating and lighting expenses. And then this one here is what we take to our statement of comprehensive income as rent, rates, and insurance expense. That is what we need to get there. But somebody was asking me, that one is under adjustment. I was trying to cover the concept of prepayments and accruals, and also depreciation and accumulated depreciation. But remember, if you are going to deal with this part, or you want to answer part A of this particular question, the original trial balance without any adjustments, then you simply stop at this point. Anything that is below that, no. The only thing you are going to do is to look on how to treat, these items in this particular section. You only look on how to treat these ones here, because after this is when you now have the adjustments. So before the adjustments, are you able to come up with a balancing trial balance? So trade receivables, you know very well that is an asset. So asset is going to have a debit balance. An asset is going to have a debit balance. You know very well that trade payables will be having a credit balance. Then your revenue will be having a credit balance, capital, credit balance. Return outwards, remember, it's going to go the opposite side of purchases. So when you do purchases, what are you going to have? Purchases also goes the opposite side of revenue, because revenue we are going to credit is an income. Purchases are an expense. So we put it here. But then our purchases, some were returned. So if some were returned, it is going to reduce our purchases. Then we have discount allowed. You are allowing these people some discount. It is an expense. If you allow them a discount, it is an expense. You are reducing your revenue. If they allow you, or if they give you now discount, that is discount received, that's an income. Discount received is an income. And you can see it is going to the opposite side of purchases. You receive discount when you did purchases. That's why we have it there. Return inwards. You sold goods, these customers returned goods back to you. So when you made sales, it was credited. When you now want to reduce what you credited, you debit that account. Distribution costs, that's an expense. Then rent and rates insurance, that's an expense. Eating and lighting, that's an expense. Postage, stationery, expense. Advertising, expense. Salaries and wages, expense. Credit loss, bad debts, cash on hand, that's an asset. Cash at bank, that's an asset. Inventory at the beginning of the year, that's an asset. Depreciation expense, of course, that's an expense. That is what we need to know. So let me see what we are having here. Depreciation, that's an expense. So some people will be struggling in the exam room. They want to ensure that everything is balancing. So what you do, go to those items that you are sure of first. Okay, let me see. If on accruals, one assumes that the entire accrued expense was never recorded and does this entry: debit respective expenses and credit accruals. What's the Of course, if it was omitted, they will tell you. If it was not omitted, they will also tell you. That one will be clearly indicated. So let's see. So by just doing these ones here only, assume you do not know what to do with the other items. assume you do not know what will happen with these other items, first of all, do them in this order. Because if you look at this, every correct entry will give you marks. So don't struggle to make things balance. Even though the examiner is telling you here that the original trial balance without adjustment, make it to what? To balance. Each section should have the debit and credit columns duly balanced. Yes, well and good. But what if you're not able to get these other items? The ones that you've been able to calculate already will give you marks. So drawings, how do we treat drawings? I want to take you now back to this part. Drawings, how do we treat drawings? 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 Less from capital, okay. So here I'm referring to debit or credit. How do we deal with the drawings? Are we going to debit or credit? How do we treat drawings? We debit. Drawings we debit. So we have our drawings here. We are going to debit it. Then I have some items remaining here. Credit loss, that is bad debts. And then expected credit loss. So expected basically means we have expected credit loss and we have the credit loss itself, which you are being told it is bad debt. So how are we going to treat this one here? Let's start with this. The credit loss, that is bad debts. How are we going to treat it? How are we going to treat it? How are we going to treat our expected credit loss? How are we going to treat our expected credit loss? Yes, let me see if these good people will be able to get me that. Our expected credit loss is a provision. So provisions are liability. And then the credit loss, that is bad debt, is an expense. Okay. I can see what my good people are saying here. So this credit loss is an expense. I debit it. And then my expected credit loss is a liability. I mean, I credit, yes, I credit this and then I debit the expense. If you look at this, is our unadjusted or unadjusted trial balance balancing? Is it balancing? Is it balancing? Is it balancing? If we get, of course, mine I'm able to see is balancing. What about from your side? Let me see. Let me see what these good people are getting. Are you really also balancing yours from the other side? Are you also able to balance yours from the other side? Are you also able to balance yours from the other side? Are you also able to balance yours from the other side? It is only Fozia who has been able to balance. How about the rest? How about the rest? Are we all able to balance our trial balance? Yes, Phil is able to do that. Let me see the third person. We are 24, so at least 24 or 20. Yes, Renga is able to balance that. Gladys, I want to see Ododa. Ododa, are you able to balance your trial balance? Are you having a balancing trial balance? Tabi is able to do that. Ododa, let's see if Ododa is able. No, Ododa, what are you missing now? Because if I look at this one here, I was doing it one by one for you to understand the steps that we are going to follow to do them. You first of all take what you are sure with, that this one will be debited, this one will be credited. Once that is done, then you now look for what you do not know, where to put, and reason out on how to adjust them. So Ododa, I want maybe to help you so that we may end our class at this particular point. Are you able to share your screen with us? Then we see what you are missing out. Are you able to share your screen with us? Are you able to share your screen with us? Is the accumulated depreciation the original value or the adjusted value? Okay, that's a good, don't have the questions. So if you are not even having the question, it means you are just listening to what we are saying. This is a practical thing that you must participate. You must do it as I do it. You must do it from your side as I do it. This paper, I shared it in the WhatsApp group. This paper was shared in this particular meeting. So you just must look on how to get the paper and follow as we do. It is a practical thing. And this thing is huge. So you have to get used to following instantly, not waiting for the video. Okay, so somebody is asking me about the accumulated depreciation, whether it is the original or the adjusted figure. This is the original. This is the original, 31,510. The adjusted one, I think we had it somewhere here. The adjusted one is 31,630. So this is the original. Remember, they want us to do it without doing any adjustment. You just use the figures that I have within this highlighted part to come up with a trial balance, a balancing trial balance, which we've all seen is balancing. So that is what they were required to do in this particular, that's what they were required to do in this particular sitting. So what they're also testing you on here, remember they want you to do what? Prepare an audit schedule for 8 columns with the following headings. So what they want you to do is not to come down here once you are done with the adjusted trial balance, you come down here and do the adjustment. No, just come to this other column. So you'll come here, this one here, you are through with Roman 1 of that particular or of this question. You are through with Roman 1. So this is the original trial balance. The original trial balance, the original trial balance is already calculated there. Is already calculated there. So this is it. This is it, the original. So when you now move to part B of that question, the adjustments are now being worked on at this particular point. So the adjustments, you now do them at this particular point. You now have your debit, now have your credit. You start looking for the adjustments one by one. So remember the image that I was talking about, what are you going to debit? What are you going to credit? So you have to know the item that you're dealing with. Are you dealing with an asset, liability, capital, expense, or income? So for example, we have insurance prepaid. Insurance prepaid, a prepayment. Is it going to be an asset or a liability? Closing inventory, is it an asset or liability? Prepaid rates, so you are going to do what we call debit and credit, so that at the end of the day, once you are through your adjustments, they are also going to balance, because it is a double entry thing. If I debit one account, I'm crediting another account, so already it is balancing. If I debit one, I credit the other one, it is already balancing. If I credit one, I debit the other one, it is already balancing. So once I'm done with the adjustments, here, the missing figures here, I will be able to have another set of balancing debit and credit balances. Once that is done, Once that is done, you'll be through with the Roman 2. You now move to Roman 3, a draft profit or loss items. So a draft profit or loss statement, you basically now know very well that revenue on the credit. So just look for the statement of comprehensive income items, which I'm able to see. I have my revenue, I have return outwards, I have the discount allowed, discount received, purchases, returns inwards, distribution cost, drawings, rent and rest if it is for goods, eating and lighting, postage, stationery and telephone expenses, advertising, salaries and wages, credit loss, that is the bad debts, so that's an expense. Then we also have inventory. You know how to treat the inventory in the profit and loss. Then, of course, accumulated does not appear there, but depreciation expense has a space there. That is what you need to do. Then you come with a draft of statement of financial position. So that is what you are required to do. So what I want you to do, we cannot go beyond this hour. I want you to create time, maybe try to do the remaining part so that when we meet tomorrow or next week, you are able to interact with that item for the second time and now understand why you are defeated. But if you interact with it for the first time, you may not be able to create that good environment for learning and mastering the concept. So I believe that's enough for today, unless there's a question. That's enough for today, unless there's a question that I need to take care of